The going concern discussion we talked about a little bit earlier with how a business operates independently is true if we're in a corporate form, which is the far right here and probably what you're used to thinking of when you think of a business, a big corporation that's got employees and all of that. There are a number of businesses that don't operate that way, though. Sole proprietorships and partnerships being two of them. Those are the two of the simplest. A sole proprietorship is sort of the default business operation. If I make a sandwich and I sell it to you, then I have, by default, done business as a sole proprietor. There is no independent corporation that sold you that sandwich. It's me who made you that sandwich. That's a sole proprietorship. A partnership was, let's say, my wife and I partnered up and made you a sandwich and sold it to you. By default, it's a partnership. There was no in between. There was no corporate between the two of us doing the work and selling you the sandwich. A corporation, on the other hand, there is that go-between. So when you go to Subway and you buy a sandwich, you're not buying from the individual that made the sandwich for you. You're buying from Subway Corporation, who is paying that individual for their time to make the sandwiches for you. So Subway Corporation has got money coming in terms of revenues and expenses going out in terms of expenses. If you're an owner of Subway Corporation and you want some of that cash, you've got to pay yourself a dividend or pay out some form of owner's equity, some sort of bonus, which we'll discuss in the next chapter about dividends on the balance sheet. But having that separation means that there is a distinction between the operators of the business and the business itself, which can be useful from a legal perspective. Because if you choke and die on my sandwich, you could theoretically sue me and take my house, my car, any of the assets that I have individually. If you choke and die on a Subway sandwich, you can sue Subway and get whatever assets the Subway Corporation might have. Maybe you can get that location, you can get the bread, you can get the cash in the bank, which is pretty nice. But if someone else owns a piece of Subway Corporation, the owners of Subway Corporation, you can't go get their house or their car. It stops the liability at the person's interest in the corporation. So you can take the corporation for all that they're worth, but if an individual is an investor in that corporation, they are held harmless from anything that the business does. There's also a tax impact, which we'll talk about in later chapters, but sole proprietors pay all of their taxes on an individual level. Corporations have to pay those taxes twice, essentially. They pay the tax on the corporate level, and then when they pay dividends to their investors, those dividends are taxed as well. We'll talk about that in the tax chapter and what dividends are, so don't worry about it too much, but understand that you have to have a corporation in order to have that separation between the operators and the owners of the business. If you've ever seen LLC at the end of a business, that stands for Limited Liability Corporation, and it essentially is a corporation form for smaller businesses. Now, there's not a size limitation. You can have a physically very large LLC, but as they get complicated and as you start wanting stock investors, you need to move into a more of a corporate form.